The 2008 global financial crisis stands as one of the most profound economic disruptions since the Great Depression, reshaping financial systems, government policies, and international power dynamics. But what if this defining economic catastrophe had been averted? In this video, we are diving into a counterfactual timeline where smarter regulation, responsible lending, and decisive interventions kept the world from the brink. How would your life, your job, and the global economy be different if the greatest economic catastrophe of our generation had been averted? Stay tuned as we unravel the alternate reality of a crisis that never was, and discover how one event reshaped or could have spared the world as we know it. Welcome everyone, I'm George, an economist who explains the real-world economics you actually deal with. Now let's answer the question, what if the world's most devastating financial meltdown was just a near miss? Let's explore the ripple effects of a crisis that never happened. Before envisioning an alternative timeline, we must understand what would have been prevented. The actual global financial crisis stemmed from several interconnected factors that created a perfect economic storm. The crisis originated from excessive risk-taking in a favorable macroeconomic environment, coupled with increased borrowing by banks and investors. Financial institutions borrowed increasingly large amounts to expand lending and purchase mortgage-backed securities, magnifying both potential profits and, of course, potential losses. When the housing prices began to fall, these highly leveraged institutions suffered devastating losses. Subprime mortgages, loans given to borrowers with poor credit, were a significant contributor to the crisis. These high-risk loans were packaged into securities and sold to investors worldwide, creating a complex web of financial interdependence. When the housing bubble burst, the financial system's vulnerabilities were brutally exposed. Low interest rates and loose monetary policy during the 2002-2004 period encouraged search for higher yield and created substantial global imbalances. These imbalances manifested as a significant increase in the US current account deficit, mirrored by surpluses in the Asian economies, particularly in China and oil-exporting countries. Now, for our counterfactual scenario, we will consider that the crisis was averted through a combination of four parameters. First, stricter regulation of mortgage lending and securitization. Second, more effective macroprudential policies limiting financial institutions' leverage. Third, better management of global imbalances. And the fourth parameter, more careful monetary policy adjustments. Especially for the second one, research indicates that macroprudential policies limiting leverage could have reduced the buildup of financial fragility and potentially averted the run of the financial sector in 2008. With these preventive measures in place, let's now explore how the world might have evolved differently. Interestingly, avoiding the financial crisis might not have meant economic smooth sailing. By mid-2008, the US economy was already exhibiting signs of stagflation, a combination of high inflation and weak growth. Inflation had peaked at 5.6% in July 2008, the highest in nearly 2 decades, while economic growth was sluggish at just 1% in the first quarter and 2.1% in Q2 of 2008. Without the financial crisis, the US economy might have continued down this stagflationary path rather than experiencing a sharp deflationary crash. High energy and food prices would likely have persisted, eroding consumers' purchasing power, while businesses cut jobs in response to rising costs and declining demand. In this alternative timeline, the Federal Reserve would have faced a challenging balancing act. Rather than slashing interest rates to near zero to combat a financial panic, the Fed would have confronted an impossible choice: cut rates to support growth and risk further inflation, or raise rates to combat inflation and potentially trigger a recession. Given the Fed's historical sensitivity to inflation, policymakers might have hesitated to implement aggressive rate cuts, potentially resulting in a longer, drawn-out economic slowdown similar to the stagflation of the 70s. One significant consequence of the actual financial crisis was the collapse in global demand, which caused oil prices to plummet from $147 per barrel in mid-2008 to just $30 by early 2009. Without this demand shock, oil prices might have remained above the $100 per barrel mark for an extended period, further constraining economic growth and keeping inflation elevated. Without the crisis as a catalyst, critical financial reforms like the Dodd-Frank Act would not have been implemented. The financial system would have continued operating with less oversight, potentially allowing risk to accumulate further. Banking practices that contributed to the crisis, such as excessive leverage, risk derivatives trading, and inadequate risk assessment, might have persisted and even expanded. This suggests that avoiding the 2008 crisis might have merely postponed a potentially larger financial reckoning later on. The crisis prompted a fundamental reassessment of complex financial instruments, like mortgage-backed securities and credit default swaps. Without this reassessment, financial innovation might have continued unchecked, potentially creating even more complex and opaque financial products with insufficiently understood risks. The shadow banking sector, which consists of financial intermediaries operating outside normal banking regulation, had expanded considerably before the crisis and accumulated excessive leverage. Without the corrective experience of the crisis, this sector might have grown even larger and more systematically important. China's response to the global financial crisis was a massive stimulus package and monetary expansion that helped maintain high growth rates when other economies were contracting. This response accelerated China's economic rise relative to the Western economies. Without the crisis, China's growth rate might have moderated more gradually from its pre-crisis peaks. In 2007, China's GDP growth reached 14.2%, but following the crisis, it declined to below 10%. The crisis served as a watershed for China's economic growth, and without it, China's trajectory might have been different. However, China's growth model was already facing challenges before the crisis. The investment rate had increased from 25% in 2001 to 50% as a result of the stimulus package implemented in response to the crisis. This excessive investment created serious overcapacity issues. Without the crisis and subsequent stimulus, China might have faced its economic rebalancing challenges earlier, but perhaps less dramatically. The financial crisis evolved in the European debt crisis of the 2010s, with severe consequences for countries like Greece, Ireland, Spain and Portugal. Without the initial financial shock and subsequent economic contraction, the sovereign debt problems in these nations might have emerged more gradually and potentially been addressed with less dramatic austerity measures. Ireland, which became the first Eurozone state to fall into recession during the crisis, might have continued its economic expansion for a little bit longer. However, the underlying issues of fiscal imbalances and structural economic weaknesses would likely have surfaced eventually. Now let's focus on the USA. One of the most significant long-term impacts of the financial crisis was a persistent output gap. as the economy never returned to its pre-crisis trend level. A decade after the crisis, the US economy remained significantly smaller than it would have been based on the pre-crisis growth trend. Without the crisis, unemployment might not have reached 10% in October 2009, and the estimated 8.7 million jobs lost might have been preserved. However, as noted earlier, some form of economic slowdown was likely inevitable given the stagflationary pressures already building in 2008. Counterfactual studies suggest that the large adverse financial shocks of the 2007-2008 caused GDP to decline by 1.5%. Without these shocks, the economic performance might have resembled the less severe 1991 recession. The crisis exacerbated economic inequality as the percentage of Americans living in poverty rose from 12.5% in 2007 to 15.1% in 2010. Some estimates suggest that 1 in 4 households lost 70% or more of their net worth. In our alternative timeline, without the financial crisis, these severe social impacts might have been avoided or significantly reduced. However, the underlying trends of growing inequality and wide stagnation for middle and lower income households might have continued without the stark wake-up call that the crisis provided. Perhaps the most intriguing question is whether avoiding the 2008 crisis would have simply delayed an even larger financial collapse. Without the deleveraging process forced by the crisis, financial institutions might have continued accumulating risk, potentially setting the stage for an even more catastrophic failure later. The correction in the housing prices that began in 2006 might have proceeded more gradually without the financial panic, but fundamental imbalances in the market would still have needed resolution. Similarly, the excessive leverage in the financial system would have remained a vulnerability requiring eventual address. The financial crisis significantly influenced political developments, contributing to the election of Barack Obama in 2008 and subsequent political movements like Occupy Wall Street and the Tea Party. Without the crisis, John McCain or Mitt Romney might have won the 2008 presidential election, potentially leading to different policy approaches to economic management, healthcare, and international relations. While avoiding the global financial crisis of 2007-2008 might seem like a positive alternative history, the reality is more nuanced. The crisis served as a painful but necessary correction that exposed unsustainable practices in the financial system and forced meaningful reforms. In our counterfactual scenario, many of the underlying economic imbalances, excessive leverage in the financial system, unsustainable housing prices, and global macroeconomic imbalances would still have required resolution. Rather than the sharp deflationary shock that occurred, the economy might have experienced a more prolonged stagflationary period with own set of challenges. The financial system, without the sustaining experience of the crisis and subsequent regulatory reforms, might have continued building risk, potentially setting the stage for an even larger crisis later. As Warren Buffett warned, during the actual crisis, an economic Pearl Harbor was possible if systematic problems weren't addressed. In essence, while the immediate pain of the global financial crisis might have been avoided in the alternative timeline, many of the structural issues in the global economy would have persisted, likely manifesting in different but potentially equally challenging ways. The fundamental lesson remains that economic imbalances, wherever they exist, ultimately require correction, either through preventive policy measures or through crisis-induced adjustments. Well, that's it for today's video. If you enjoyed it, please like and subscribe. Also, leave a comment below and let's keep the debate rolling. See you all next week. Bye bye.